It's no secret that the stock market has been booming over the last 2 years or so. It has set new record highs in pretty much every aspect that you can think of. However, I've been seeing news article after news article from the Wall Street Journal, CNBC, and The Street saying that the stock market is going to go down and see barely any gains in 2022. So today I wanted to take a moment to talk about what these articles discuss and why they think the stock market isn't going to grow in 2022, which would be a direct contrast to what we've seen over the last few years. So if you're a beginner investor or maybe a seasoned pro that has some money in the market and you want to know exactly what might happen in 2022, make sure to stick around till the very end of this video because we're going to go over everything that's happening. But before we get into all of that, my name is Nate from Minority Mindset News, and if you like this video, be sure to smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world. We can keep making videos just like this one. Wall Street has exploded in 2020 and in 2021. In March of 2020, we saw one of the biggest stock crashes, well, I should say one of the fastest stock crashes in stock market history. And this is all because of the pandemic. If you remember, when the pandemic was first starting, that meant a lot of businesses had to shut down. As businesses shut down around the world, Wall Street got scared. Nobody really knew what was going to happen, so millions of investors pulled their money from the stock exchange. When you have so many investors pulling their money from the stock market, that means all of these businesses are immediately losing capital. And when there's a lot more sellers than there is buyers, you enter a bear market. So stock prices tanked. A lot of investors were scared of what was going to happen, but ever since then, the stock market has exploded with new value. Like I said, the Dow, S&P 500, and NASDAQ have all set new record highs back in 2020 and now in 2021. So what is going on here? Why exactly would the stock market boom if people are unsure of what's going to happen with the pandemic? Well, there's a few different reasons for this. A part of the reason why the stock market has boomed is because it is artificial growth because of the Federal Reserve. Back when the pandemic was first starting, the Federal Reserve decided that it was going to print trillions of dollars in economic stimulus to help the nation recover. Not only to help the nation recover, but to keep it from falling apart entirely. Businesses and people were not making any money. And the fact of the matter is, people and businesses had very little money in reserves to protect themselves in case of an emergency, like losing your job. And because we live in a capitalism economy, the only way for things to grow and our economy to be stable is if people are out spending money and more money is circulating throughout the economy. So the Federal Reserve stepped in and printed trillions of dollars. This trillions of dollars was in stimulus payments, direct payments to Americans worth sometimes thousands of dollars, and Americans could spend them however they wanted. It was also for businesses. We saw things created like the Paycheck Protection Program. This essentially meant that businesses could get additional money and all they had to do was not fire employees. So even though people weren't working, they were getting all of this money flowing into their bank accounts. And of course, we had extended unemployment benefits. So on top of state benefits, the federal government was going to chip in even more and give you additional money for a certain period of time. So even though people weren't working, they still had thousands of dollars flowing into their bank accounts. Now, to be fair, a lot of people saved this money. But a good portion of people went out and spent this money, which overall helped our economy. Now, I'll get into that in a second here, but this brings us to the first thing that happened during the pandemic. A lot of people went out and invested this money. And investing is a great thing, especially when markets are so low like that, because you can buy an asset at a pretty much discounted price. If a stock is normally valued at $100 per share, but the stock market crashes and now it's only valued at $25 a share, well, it's not really the company's fault to why the stock market crashed. That means that eventually that company is going to go back up and you are going to have shares in that valuable company. Of course, that's not guaranteed, but typically over time, the stock market goes up. So there was a lot of first-time investors who were entering the New York Stock Exchange, people buying assets for the first time ever. And I think one of the reasons for this is because people started to realize that their job was not going to pay them enough to survive, and they needed additional income outside of their job because working was starting to look a little unreliable. The stock market is one of the easiest and most accessible ways for people to invest their money. This is why it was one of the biggest markets to boom. I mean, literally, you can invest from anywhere in the world, and all you need is a phone and an internet connection. And of course, Wall Street loves it when there's new investors on Wall Street and when there's more money circulating throughout the economy. When people have more money, they typically go out and spend this money. Around 50% of all of the stimulus checks that were sent out were spent in about 2 or 3 days after they were received. And you've got to think, where are people spending all of this money? Well, more than likely they're buying products, and most of these products are from companies who are listed on the New York Stock Exchange. Ultimately, that means these companies are going to see mega huge profits and their stock prices are going to go up. This means that more people are interested in buying their shares and the stock market is going to boom. In addition, we saw the Federal Reserve take one more step past its usual stimulus measures and start issuing quantitative easing on Wall Street. This essentially means that the Federal Reserve was entering the market and buying bonds and treasury notes. And they weren't just buying some, they were buying hundreds of billions of dollars every single month. It was essentially unlimited for a certain period of time. That means companies were basically getting free money here. And as long as the Federal Reserve was artificially placing money into the stock market, it can't really lose. This went on for a very long time, but by the end of 2021, November to be specific, we saw the Federal Reserve come out and say they were pretty much done and they were going to start scaling back a lot of their stimulus measures. So the stimulus checks were basically ending and the unemployment assistance programs were ending too. They had to start making these measures in order to combat inflation. This is one of the biggest things that the Federal Reserve does, is monitor where inflation is and what level it's at in the United States. If inflation gets way out of control, that means that there's way too much money in your economy, and every dollar that is in the economy is starting to lose way too much value. So the Federal Reserve has to see that and make some monetary policies to try to get people to start spending less money. So cutting off those two programs is the first step. The next thing the Federal Reserve announced that it was going to do was raise interest rates in 2022. Back at the start of the pandemic, the Federal Reserve dropped its benchmark interest rates to near 0%. At the time, they were incentivizing people to spend more money because our economy works by spending more. If more people are spending more money, then our economy is going to grow. At least in the short term, this is a great thing. However, it also creates a lot more inflation. So we have millions of people going out and getting more loans, mortgages and auto loans. So those industries are going to be a lot tighter. And the housing market essentially boomed. People were taking their stimulus checks and coupling that with 0% interest rates and getting a great mortgage. Before, they might not have been able to afford a mortgage, but now they absolutely can. The auto market boomed too. We saw people buying new vehicles, and that eventually led to a supply chain issue with microchips. It eventually got so bad that now used cars are going to cost you more than a new car. And that is crazy because cars typically only lose value over time. They don't usually gain any value. But people could get a loan to get the car they wanted. They could also get a loan to get the house they wanted, so these markets started booming. And this all helps out Wall Street too. Next, the Federal Reserve is starting to pull back a lot of its bond buying and asset purchasing from Wall Street. It's going to decrease the amount of assets it buys by around $15 billion every single month until July of 2022. This is called tapering, and they're going to start tapering every single month. The reason they do this in phases is because if they do it all together, this could lead to a stock market crash. They're essentially pulling billions of dollars out of the market all at once, and that is capital that a lot of these companies rely on. So they try to give these companies ample time to start preparing for when that money is going to disappear. So these are all things that the Federal Reserve is doing in order to address inflation. But with all of this being said, the stock market is still booming. So are they just not listening? Well, the stock market is strange. So over the last year or so, we have seen a lot of industries start to boom. Tech in particular started to boom at a rapid rate. So what you've got to remember is the stock market is thousands of different companies. It's not just like one thing. So making a general statement like the stock market is going to go up or down is just that. It's generalizing every single company. There may be specific sectors or indexes that drop or rise on a given day, but it's not all just one thing. So over the last year or so, tech companies in particular started to boom. The United States and the rest of the world started pushing for a lot of these digital assets. The reason being is because so many people were at home, going to school from home, working from home, and just being at home in general, that we called these investments these stay-at-home stocks. There were a ton of tech startups that launched on Wall Street, and they started to boom because there's so much interest behind tech companies right now. And if you've been around Wall Street long enough, then this is sounding pretty familiar. And that's what brings us to a lot of these articles. A lot of these articles talk about how the tech boom of 2020 and 2021 is very similar to the late 90s and early 2000s dot-com bubble. If you remember, this dot-com bubble was when websites and the World Wide Web was starting to expand. So pretty much anybody that slapped .com on their company name was getting billions of dollars and investor interest. However, people eventually found out that these companies were pretty much worthless. I mean, just because they slapped .com at the end of their name did not make them a website giant, and it didn't make them a master in that space. This is what ultimately led the .com bubble to burst. People were investing billions of dollars into these companies and then finding out later that these companies had no way of making money and were barely a website. That ultimately crashed the stock market because there were so many public companies that were doing this, and investors basically got tricked. Right now, this is exactly what some experts and these articles are talking about. They're saying that a lot of these tech companies and IPOs, initial public offerings that have launched in 2020 and in 2021 are not and should not be as valuable as they are. They're not worth billions of dollars, and they're not really making any money yet. In the final months of 2021, Rivian, the electric car company and possible competitor to Tesla, launched its IPO on Wall Street. Now, this wasn't just a small launch. This ended up becoming one of the largest IPO launches that the stock market has seen in around 7 years. Rivian kind of carved its space in the larger electric vehicle market versus Tesla, who makes mostly sedans. And pretty much overnight, they became more valuable than General Motors and Ford. And now they have an overall value of well over $100 billion. Here is the problem. Rivian, while it's very valuable, reported that it didn't really make any money on its latest earnings report and doesn't plan to make any money for a long time. In fact, it said that it was going to make between $0 and $1 million, yes, $1 million on its next earnings report. You can probably imagine why that would be a problem. So investors are basically pouring money into this company on faith. And if this company doesn't pan out, well, investors are going to pull their money out because they're going to get scared, and they can't just leave it in Rivian forever. It's not making them any money, and investors at the end of the day are buying those shares so they can eventually start making some money. And they're not alone. There are thousands of other companies that have launched on the New York Stock Exchange that are in the same boat. And the common theme is that they're all tech companies. So by the end of 2021, we are starting to get out of the pandemic. People are starting to get back to work, and they're starting to go outside again, which means these stay-at-home stocks are ultimately beginning to drop. Now it looks like the stock market is shifting to the reopening stocks that are less tech-based. And it looks like technology and our lives becoming a lot more digital is going to be the wave of the future in general. But that doesn't mean that a lot of these companies have what it takes to survive on Wall Street. And if this is the case, then we will see millions of investors pull their money out of the New York Stock Exchange, which is exactly what happened in the dot-com bubble. And there is one more thing to consider here. Inflation in the United States is at a record high. We haven't seen inflation like this in over 31 years. The Consumer Price Index in October said that inflation and prices had rose by around 6.2%. That is a pretty fast increase. What that means ultimately is that there is a lot of money in our economy and people are going to have to pay more in order to buy goods and services. But at the end of the day, as things start to cost more, people are going to naturally start to pay less. They can't afford all of the same products, so they're going to have to cut back. A very easy example of this is if gas prices start to go up or some other utility that you absolutely need in order to survive in life goes up, then you can't exactly afford things that you want anymore. You have to kind of budget and start cutting things out. And that cutting out is going to lead to cutouts and profits for companies. Things have boomed for companies over the last 2 years. We've seen record profits and record growth because people have a ton of money right now. But when all of that free money is done and if inflation continues to rise, that could mean that people are starting to spend less. This means that when a company has its annual or quarterly earnings report, they're going to report a drop in sales, a drop in revenue, and a drop in profits. And that could lead to investors pulling their money out of those stocks. Nobody likes to see a drop in anything, especially investors on Wall Street. So they're going to want to pull their money out even before that so they can see all of those profits. So this, coupled with all of the tech companies, could lead to a stock market crash in 2022. But here's the thing. Ultimately, none of this has happened yet, and we don't really know how the Federal Reserve is going to handle inflation from here on out. We also don't know how exactly consumers are going to spend their money. I mean, the holiday season is coming up. That means people are going to be spending more, and at least for the first parts of 2022, we could see some awesome earnings reports. And I don't really know. A lot of these tech companies that have launched on Wall Street might suddenly start making billions of dollars in revenue, and investors may have been right for investing in them early. Nobody really knows. Right now, it seems like there's a little bit of a bubble when it comes to tech stocks, and it seems like that is going to continue because we have evidence that these companies aren't really going to make money. On the flip side, we don't really have any evidence that inflation is going to suddenly slow down. President Joe Biden recently passed his $1.2 trillion infrastructure bill and is trying to pass his $2 trillion social spending bill. That means in order to fund these bills, the federal government is going to have to print around $3 trillion. Now in 2020 and in 2021, around $3 to $5 trillion was already printed. That means inflation is not going away in 2022. We just haven't felt all of the effects of it yet. Anytime you print money, inflation is going to rise. That's pretty much how inflation works. If the money supply is raised, all of the money that is currently in circulation becomes less valuable. So with all of this money printing, that means inflation is going to go up, which means prices of goods and services are also going to rise. But if they rise too fast, then that means consumers are basically going to be priced out of the market. They will only buy the things that they absolutely need, and that means a drop in profits for companies. High inflation, less spending, and a bubble in the tech market could lead to a stock market collapse in 2022. But inflation could also become very contained if the Federal Reserve acts fast enough. Either way though, this is going to lead to less spending, and Wall Street is not going to like that. If you are an investor, always do your due diligence and never blindly listen to people on the internet. That includes me here. Research and protect yourself because nobody really knows what is going to happen. So at the end of the day, you need to make sure that you are making the best decisions for you and your family. But either way, buckle up because things are going to get very wild in 2022. But now I want to hear from you on this issue. Do you think the stock market is going to crash in 2022 because of a tech stock bubble or inflation? Or do you think that these two things are completely irrelevant to the stock market's success in 2022 and the stock market will continue to boom to record highs for the foreseeable future? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you like this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.